The following production is presented by League Info Site and the Credit Union Broadcast Experience, CubeTV.
Hello, I'm Sean Wolbert with CubeTV. Thank you for joining me on the new set of the CU Compliance Connection by InfoSite. We continually strive to make our compliance training offerings and presentations better, and I think you'll agree this update is worthwhile. This special quarterly segment of CubeTV will review compliance and regulatory issues worth noting that occurred in the fourth quarter of 2012. We will assess compliance issues that have gone into effect and review important upcoming deadlines for your credit union. The fourth quarter was relatively quiet, with continued focus on proposals for new regulations from both the NCUA and the Consumer Financial Protection Bureau. However, there are some big issues on the horizon. As we look ahead at the end of this presentation, we will focus on the CFPB's regulatory implementation of the Dodd-Frank Wall Street Reform and Consumer Protection Act and new rules issued from the NCUA. The handout provided with this presentation includes website links so that you can obtain additional information that may be helpful to you and your credit union. The primary regulatory issue that credit unions faced in the fourth quarter of 2012 was the implementation date for the NCUA's new rules on troubled debt restructuring, or TDRs, loan workouts, and non-accrual. This went into effect on the heels of the new interest rate risk policy and program requirements. Therefore, compliance for the fourth quarter was very focused on accounting through investment and lending practices. The new TDR rule allows credit unions to modify loans without having to characterize them as delinquent, as long as they're performing. The best part about the rule is that it eliminated the manual dual tracking of all TDRs for 6 months that was previously required so that they could be reported correctly for the call report. Delinquencies on TDR loans are now calculated consistent with the modified contract terms, not the original contract terms of the loan. As part of the new rule, credit unions must have written policies and procedures to address loan workout arrangements and must set standards for non-accrual, which requires the discontinuance of interest accrual on loans 90 days or more past due. By December of 2012, credit unions were finalizing their SAFE Act audits and registration renewal for the credit union and all mortgage loan officers through the National Mortgage Licensing System and Registry. This process often created questions about training requirements due to advertisements posted on the NMLS site for required training courses. For credit unions who are federally insured, there are no specific training requirements for MLOs, other than to be informed of the registration requirements of the SAFE Act and be instructed on how to comply with the requirements and procedures. Credit unions who are not federally insured must make sure that their MLOs receive the 20 approved hours of education before licensure and 8 continuing education hours each year to qualify for renewal. Because SAFE Act renewal is a relatively new requirement, which was just transferred to the oversight of the Consumer Financial Protection Bureau, this process has not yet become ingrained in mortgage loan officers' minds. It is also important to note that Congress did not extend unlimited share insurance coverage on non-interest-bearing transaction accounts. This additional share insurance coverage ended on December 31st, 2012. This unlimited coverage was separate from and in addition to the coverage provided to members with respect to other accounts held at the insured credit union. The NCUA recommended that credit unions determine if the credit union has member accounts with a temporary unlimited share insurance coverage, communicate the changes in the insurance coverage to the members, ensure that your credit union disclosures for affected accounts are updated to properly disclose the level of insurance coverage available, and finally, make sure that the posted signs and notices mentioning unlimited share insurance coverage are removed. The compliance issues that credit unions faced in the fourth quarter of 2012 were minor compared to the regulatory changes that we will have to manage in 2013. Several issues that have been pending with the NCUA and the Consumer Financial Protection Bureau are being finalized, and we need to review what compliance priorities are in the first quarter of this new year. On January 10th, the Consumer Financial Protection Bureau issued final rules for high-cost mortgage and home ownership counseling amendment, ability to repay and qualified mortgage standards, escrow requirements, and mortgage servicing. Due to the complexity of the new rules, we will provide a brief overview here and a complete review of the requirements on upcoming Compliance Connection presentations on Cube TV. So stay tuned. While credit unions work through 1,351 pages of new regulations, the CFPB will continue to focus on changing lending the way we know it. We still await final rules on mortgage loan originator compensation, appraisals for higher risk mortgages, appraisal disclosure requirements, and the combined TILA and RESPA forms. The Consumer Financial Protection Bureau released the final rules for high-cost mortgages and escrow accounts through the High-Cost Mortgage and Home Ownership Counseling Amendment, which amends the Home Ownership and Equity Protection Act, or HOEPA. The rule expands the loans currently covered and will now include most types of mortgage loans secured by a member's principal dwelling, including purchase money mortgages, refinances, closed-end home equity loans, and open-end credit plans. The regulation requires credit unions offering mortgage loans that exceed certain APR thresholds to disclose terms, costs, and fees associated with the high-cost loans early in the process and certify that the members have received homeowner counseling regarding their loan. In a release, the CFPB also said that the high-cost mortgage regulation will ban risky mortgage features like balloon payments and prepayment penalties for qualifying mortgages, prevent charging loan modification and loan payoff fees, set a late fee cap at 4% of the amount of the payment that is past due, and prohibit a lender from rolling closing costs into the loan amount. This rule will take effect on January 10, 2014. The escrow changes finalized by the CFPB through Regulation Z will require escrow accounts for higher-priced mortgage loans that must be established and maintained for at least 5 years. This rule does have an exemption from the escrow requirement for small creditors that operate predominantly in rural or underserved areas. To be eligible for the exemption, a credit union must make more than half of its first lien mortgages in rural or underserved areas, have an asset size less than $2 billion, together with its affiliates have originated 500 or fewer first lien mortgages during the preceding calendar year, and together with its affiliates, not escrow for any mortgage it or its affiliates currently service, except in limited circumstances. Under the rule, eligible credit unions need not establish escrow accounts for mortgages intending at consumption to be held in the portfolio, but must establish accounts at consumption for mortgages that are subject to forward commitment to be purchased by an investor that does not itself qualify for the exemption. This rule takes effect on June 1, 2013. The CFPB made an additional amendment to Regulation Z through the ability to repay and qualified mortgage standards rule. This rule was founded on the experiences during the mortgage crisis, when many mortgages were made without regard to a person's ability to repay a loan. The final rule describes certain minimum requirements to make the ability to repay determination, but does not dictate that credit unions follow particular underwriting models. At a minimum, credit unions generally must consider 8 underwriting factors, including current or reasonably expected income and assets, current employment status, monthly payment on the loan, monthly payments on any other loans, monthly payments for mortgage-related obligations, current debt obligations, including alimony and child support, monthly debt-to-income ratio, or residual income, and credit history. Credit unions should use reasonably reliable third-party records to verify the information they use to evaluate the factors. The rule does establish certain protections from liability under the requirement for qualified mortgages. Additionally, the rule limits the prepayment penalties and requires a credit union to retain evidence of compliance for 3 years after a covered loan is consummated. This rule becomes effective January 10, 2014. On January 17th, the CFPB released the new mortgage servicing rules, amending Regulations Z and X, which cover 9 major topics. Servicers must provide a periodic statement for each billing cycle containing, among other things, information on payments currently due and previously made, fees imposed, transaction activity, application of past payments, contact information for the servicer and housing counselors, and where applicable, information regarding delinquencies. These statements must meet the timing, form, and content requirements. Servicers must provide a member whose mortgage has an adjustable rate with a notice between 210 and 240 days before the first payment is due after the rate first adjusts. This notice may contain an estimate of the new rate and new payment. Servicers also must provide a notice between 60 and 120 days before the payment at a new level is due, when the rate adjustment will cause the payment to change. Servicers must promptly credit periodic payments from borrowers as of the day of receipt, and servicers are prohibited from charging a borrower for force-placed insurance coverage unless the servicer has reasonable basis to believe that the member has failed to maintain hazard insurance and has provided the required notices. An initial notice must be sent to the borrower at least 45 days before charging the borrower for the force-placed insurance coverage, and a second reminder notice must be sent no earlier than 30 days after that first notice and at least 15 days before charging the borrower for force-placed insurance coverage. Servicers will need to meet new requirements in responding to error resolution and complaints of errors. As always, the new rule requires a credit union to develop policies, procedures, and requirements that meet the standards of the new regulation. Servicers must establish or make a good faith effort to establish live contact with a member by the 36th day of their delinquency and promptly inform such borrowers, where appropriate, that loss mitigation options may be available. In addition, a servicer must provide the member with a written notice with information about loss mitigation options by the 45th day of the member's delinquency. Servicers are required to maintain reasonable policies and procedures with respect to providing delinquent members with access to personnel to assist them with their loss mitigation options where applicable. And finally, servicers are required to follow the specified loss mitigation procedures for a mortgage loan secured by a borrower's principal residence. If the member submits an application for loss mitigation option, the credit union is generally required to acknowledge the receipt of the application in writing within 5 days and to inform the member whether the application is complete, and if not, what information is needed to complete the application. The credit union is required to exercise reasonable diligence in obtaining documents and information to complete the application. This is just the tip of the iceberg with the Dodd-Frank regulation, but the summary provides a good overview of what you can expect. There is an exemption to several parts of the regulation for small servicers that service less than 5,000 mortgage-based loans. It is important to understand the definition of a mortgage loan when determining if you qualify for the exemption. Mortgage loan is defined in the regulation as any mortgage loan secured by a first or a subordinate lien on residential real property, excluding lines of credit. The NCUA also provided credit unions with a few new rules on January 10th. The first is the finalization of the Small Credit Unions Rule, which revised the definition of a small credit union by raising the asset threshold to $50 million. This change lessens the compliance burden for small credit unions by providing relief from the risk-based net worth and interest rate risk requirements. This rule change means that 2,270 additional credit unions now fall under the NCUA's small credit union definition. It is important to note that this rule will not impact the NCUA's recent decision to streamline exams for credit unions under $10 million in assets. The threshold for those exams remains at $10 million. The NCUA also finalized another beneficial rule for credit unions that extends the acceptance period for low income designation from 30 to 90 days. Their final action was to issue the ruling that amendment that the definition of a credit union in troubled condition to permit the NCUA or a state supervisory authority to declare a federal or state chartered credit union to be in troubled condition. This wraps up our review of the regulatory issues from the past quarter of 2012 and provides a glimpse into the future of what is in store for credit unions in 2013. Please stay tuned to the Compliance Connection for detailed reviews of the NCUA and CFPB's future actions. Thank you for joining me. I'm Shawn Wolbert with the CU Compliance Connection by InfoSight, only on Cube TV.
Thanks for watching the #1 compliance program for the credit union community. Stay tuned.